Let's get in Dinshaw Irani, then CEO Helios Mutual Fund, who joins us on the show. Hi Dinshaw, good afternoon and good to see you in. Dinshaw, need to get straight to the big stock that we've been talking about, HDFC Bank. Just looking at a sell side note that came out an hour or so ago, they're saying you just can't sell a bank trading at around 13, 14 times its forward earnings, even if you have to skim down the earnings expectations by 5-6% odd. What is your view? Is it providing a good entry opportunity as of now? Or you'll say, well, there are plenty of better opportunities out there. Let's avoid this for a couple of quarters and then we'll revisit it.
Good afternoon, Nigel, and a very good afternoon to your viewers and your team as well. So basically, I guessed your question is going to be that you're going to start off with that. It's our favorite stock, right? I mean, it's our number one holding across all our portfolios. So I knew you were going to ask me this. But one thing that I would like to highlight here, Nigel, is that you're talking about 13, 14 Ps, but for a growth rate which is going to be 16, 17% over the next couple of years, in earnings growth I'm talking.
Yes.
If you're ready to give 27, 28 times P's to a sector which is going to grow at 10, 11%, I'm basically referring to IT, right? Why not a bank which is going to be the biggest participant in India's growth story, and this is the largest bank that you have? So we're all for it. In fact, we've been yesterday after the big correction, we did add some. Unfortunately, we don't have much money today to add any. Otherwise, you'd add more here. So we quite into the stock, and we believe that this is the one which is going to lead the rally if the banking sector does rally later.
Okay, Dinshaw, hi, good afternoon. See, that's the thing. That's what they say about fund managers. You know, you need to be patient. You need to sort of look beyond the obvious, and what you're saying displays every bit of that and more. But let me try and play devil's advocate for a bit. The thing is, the stock has already been testing a lot of people's patience. For the last 1 year, it's one of the worst performing stocks on the Nifty. And coming on the debate is that this issue with HDFC Bank, it will take a while to correct before they can get their deposit franchise in order. And, these deposits, the argument is that they'll come at higher cost because there'll be retail deposits, so margins will come under pressure, etc., etc. What do you say to a lot of these arguments that we've heard over the last 24 hours?
So basically, Surabhi, it's going to be for the industry as a whole, right? Not for HDFC alone. Fine, I mean, HDFC has a credit deposit ratio of 110% and so on and so forth. But the fact is that if any franchise is capable of raising money at a reasonable price, and capable of raising deposits as a reasonable price, it'll be HDFC. If others are, I still remember one of the statements that Aditya Puri had made, that if I was to lose my shirt, the others will be running around without their clothes. So that's what it's going to be down here. So we're quite comfortable with the way HDFC Bank is placed today. And I think, if anything, that's the best-in-class stock you'll get in the private sector.
Okay. Well, we have IndusInd Bank, which is reporting, and it's probably going to come out post-markets. That stock is down around 2% ahead of its numbers. We have ICICI Bank on Saturday, Kotak, Axis on Monday. Dinshaw, hi, welcome to the show. Are you watching out for those numbers more keenly, the CD ratios, the net interest margins, and then are you probably going to make a more calculated call towards your exposure towards financials?
No, not really. I mean, as we've been always saying, okay, obviously you look out for these nuances when the results come out, but one quarter will not be changing the overall picture for the medium term as such, right? The fact is that when your GDPs are growing, when your per capitas are growing, the financial sector is one that is going to be partaking in this party all along as such. So it's obvious that you need to be there. You need to be focused onto that sector. And the fact is that you need to be in stocks which are probably the best around as such. They've tested, they're time-tested stocks. In fact, that's why we picked out these names. We know that even in bad times, they manage their assets very well. They manage their CD ratios very well as such. So that's why we are there in these names. And I think we're very comfortable being there in this sector as a whole. I will not tell you beyond the only name that I've revealed to you, which all others are there. But you can very well look at my portfolio. You can take a guess what all stocks we have in our portfolio.
Dinshaw, some of these new age themes, they suddenly have been doing well. So I need to ask you about some of them. Zomato, case in point, that's moved to the high point of the day as we speak. Paytm, well, it promised, but some negative news flow comes in there and keeps pulling back the stock. What's your view on these themes? Some of them were big underperformers at one point of time. Now they've pulled back from the lows. Your view, how are you all positioned on them?
So Nigel, actually, what do you look in a platform? These are all platform plays, right? I mean, the three things that have to tick off as a yes on a platform plays: do they provide convenience? Is that convenience and cashable? And is that a mass convenience that is available as such, right? All these platforms tick off, put a yes tick on that. The only tick that you need, you need a cross, is that are they easily replicable? In the case of Zomato and Paytm, you know that they're not easily replicable. In fact, in the case of Zomato, globally, you've seen that across countries, across markets, there are only two big players who work out on the food delivery business as such. Yeah, so that's why that's a given, and potential in India is huge for all these platform plays, provided they do give that convenience that is needed by the masses. And that's why we are fairly into these two stocks as such, which I just mentioned. And beyond that, we think the others which are there in this platform plays are, one, the replicability is quite evident in those. So that's why we're not there in other names as such. So.
By the way, we're talking internet companies, and look at the fall in subscribers for IndiaMart. That stock's just falling off the cliff now, 5.5% down. Because the fall is really huge. I mean, from 2,000 plus, they've come down to about 1,826 to be precise. And that one single parameter is enough to spook the market, especially on a day like today. You don't want any stats which could, indicate any kind of a business disruption or any kind of a problem in the model. And right now, we need more evidence, of course, on IndiaMart, but that one number has not gone down.
The last quarter, they said that they affected some price increases, and that's what affected the addition. And they said that next couple of quarters it'll be weak, but I don't think the street was prepared for a number, even sub what we saw in quarter two. They're also given us this guidance that from the start of FY25, we'll be looking back at around 5,000 subscriber addition. So for the time being, this number, the quarter three number is weaker than quarter two. They had pushed through a price increase, and that could have impacted some subscribers as well. Explains why that stock now is getting a hard knock. It's down close to around 6.5%. That recovery actually looks like it's been pushed back by a couple of quarters. That's why the stock is down 7%. Oh. So nothing close to 5,000, and even weaker than what we saw in quarter two.
Absolutely. IndiaMart definitely not sort of in step. We're talking platform companies. Dinshaw, let me come to the large IT services. Now, this is the part of the market that you've never liked. You've never minced your words on it. But we did see this big pop, and we saw a lot of upgrades, by the way, from a lot of brokers saying that we're probably at the bottom and it'll turn from here. TCS, to be honest, is indicating the same thing. Are you any more convinced now?
So basically, what did they indicate, right? I mean, the commentary, if I was to use a leaf out of pen, they became from hawkish towards neutral. They're still not neutral as such, right? There's no positives coming out here. All they mentioned is that, the cost-saving deals are picking up. There's no discretionary, still way out of the way. The P re-rating should have happened because of discretionary, because of margin expansions. That's not happening right now. I mean, they're holding on to the margin. That's a good part. Mainly because the manpower costs have eased out to that extent, which actually to me is not that great news, because you still don't have a bench. Your utilization levels are at all-time peaks, and you're not building up a bench also. So it's obvious that they also are seeing some kind of uncertainty going forward. So that's why we believe that. And mind you, one has to already build in the fact that if US is looking at cutting off rates in the coming future, they're talking about some kind of a recession hitting them. So if that happens, the IT spends are not going to happen in a rush. So our feel is I think everybody's jumped the gun rather on this one.
Okay, well, you could delay decision making, but you need medicines. So Dinshaw, I'm going to ask you about Sun Pharma, because that stock is the top gainer on the Nifty this afternoon. It's a weak market. It's seeing buying at these levels, and it's going to take one of its US subsidiaries private, Taro. They're paying over, I think, $300 million for that. What is your take on Sun? Very strong specialty business, good margins, which have improved in the past couple of quarters. Would it be a portfolio stock?
So I won't tell you whether it's what's our view on Sun Pharma per se, but I'll tell you about the pharma industry as a whole. we are more comfortable with domestic-facing pharma than the US one. Yeah, the US cycles have turned in a way. It's obvious that the pricing pressure, which was there in the US, is easing out. There's still some pressure left there, but it's easing out in a big way. But our belief is that the domestic pharma plays are more, or rather the CDMO plays, if at all we're looking at exporters out of India, the CDMOs are the guys we are more comfortable with. The domestic pharmas are definitely going to be big gainers, because you're talking about, as I said, that if your discretionary spends are going to go up, your spends on healthcare, your spends on your own self are going to move up, on your health, your own health is going to move up quite appreciably. And that's why we're more comfortable with these kind of names rather than pure A&DA players who are playing out on patent expiries in the US.
Okay, all right. Dinshaw, good talking to you as always. Thank you very much for joining in, and I look forward to our next conversation. Thanks for being with us today. That's a chat on pharma. By the way, Ekta, remember you were telling us, just to remind our viewers,